was I optimized underwater decompression schedules in concert with the U.S. Navy. And the optimization of any closed system via mathematical modeling is really very similar mathematically, and that's what we do. We look at the movement of price on any given financial market as a factor of multiple independent variables. We determine what those independent variables are. We put them in a multivariable equation, and then we seek to optimize it in order to create a system that really, with great precision, determines the future direction of price on your trading chart. And this is us at www.rightlinetrading.com. Now, there's a problem with current technical analysis. Unless you do it magically and trade on a chart that doesn't have any indicators, which essentially is not possible. If you want to be a price action trader, you are never going to make money. You're going to get a lot of winners, but you're going to pull in a lot of losers. You have to use some type of technical analysis. Now, the problem with this is that 95% of day traders fail. And what the cause and the real problem associated with that is that 95% failure rate never improves over time. There's no evolutionary process in this business where it starts out as a 95% failure rate, and then each year or every 2 years that percentage drops and gets lower and lower and lower and lower. It's just stuck there. And the reason it's stuck there is that there's really no scientific analysis of what components of technical analysis work and what components don't work. So everyone is stuck using this essentially and really fundamentally the same set of indicators and the same indicator and the same technical system that was used 20 years ago that has cost probably hundreds of thousands of traders their account. And each generation of day trader does not learn from the previous generation. And they accept current dogma without mathematical verification. What we have done here is looked to mathematically verify every single indicator that we use, and we've eliminated almost every standard indicator because they just don't predict the future movement of price. They have no forward-looking ability. All they do is lag, and they tell you where price has been, but they don't tell you where price is going. And if you do a Nexus Lexis search of the world literature, you'll find that there's very, very little scientific analysis looking at the predictive value of a trade signal using standard indicators, and that includes Fibonacci. Now, these are the independent variables that govern the movement of price. The first is the multi-time frame analysis of trend. Now, I'm not going to go into each of these more right now because we're going to go over them each individually. The multi-time frame direction of correlative markets. Now, I hear a lot of people talk about institutional money and the direction of institutional money. Well, you can try to read that in price action, but I'm telling you, it's not possible. You have to have indicators that show you the direction of institutional money flow. And the correlative market indicator that we have is the best one to show you what the large institutional traders are doing with their money. You look at the multi-time frame analysis of order flow, the multi-time frame analysis of momentum, and you see our market profile is just unbelievable. We've added a component to it that I don't believe you may be familiar with. Now, the dependent variables would simply degrade the precision of your entries are things like the oscillator, and I'll answer all questions at the end, are the oscillator, MACD, Fibonacci, classic Elliott wave. I don't want to spend too much time on this, but the oscillator is a really nice indicator. It's really an elegant formula, but it has no forward-looking ability, and neither does MACD. Now, Fibonacci was an 11th century mathematician. When he created Fibonacci transformations that ultimately gave rise to Fibonacci numbers, it was literally 800 years before the advent of the financial markets. And some guy got the bright idea of thinking, well, Fibonacci numbers are going to predict the future movement of price in the markets. And boy, they are totally wrong. We've done a mathematical analysis of fib levels, and they just don't work. And this indicator, because for some reason it's so compelling, so many people want to use it, because so many software vendors are offering it, that it just sucks more money out of anyone, out of traders' accounts than any other indicator I know. And classic Elliott wave is a disaster. I mean, it looks great if you read a book, but if you try to apply it to the actual movement of price, it's very, very difficult to trade, if not impossible. So let's take a look at the first indicator that is going to provide you with forward-looking ability, the ability to determine where the future movement of price is. And you're going to see, by using these indicators, you're going to get a great idea of how to trade a market open and how to trade a gap. Because these are the indicators that are going to tell you how price is going to move out into the future, whether to fade a gap or whether to trade into the gap. It's all based on institutional money flow. We're going to talk about gaps in a minute. Now, line one is the multi-time frame assessment of momentum. When the line is red, the two higher time frames than the trading chart you're using has momentum moving to the downside. And we use modified Heikin-Ashi momentum. MACD is a great momentum indicator, so is the oscillator, but we found that Heikin-Ashi momentum is the best. Now, when the bottom line is red, it means that order flow is aligned to the downside on both time frames. Now, what does our order flow indicator look at? It looks at the number of traders sitting at the bid and the number of traders sitting at the ask on your dome. It looks at market depth, and it tells you whether there are abundance of buyers or there's an abundance of sellers. And when it's averaged over two time periods, it gives you a very accurate assessment of whether there's selling pressure or buying pressure on the market that you're trading. It's time frame independent, and it works on any financial market. Let's take a look at how it performs. Now, this is an area of resistance. When both momentum and order flow are aligned to the upside, you can only trade price long. It doesn't matter whether you're trading out of a gap, market open, a continuation trade. This is the direction you have to trade. There's a preponderance of buyers on the dome, and there's overabundance of buyers, and momentum is taking the market to the upside. When they align, you can see all these traders caught in the counter trend direction. They're all trading short, and they're trading off of oscillator divergence or MACD divergence, or they're trading off of Fibonacci resistance, and they're all going to get beaten to death. That's what happens. Now, here's another trade. I took the time frame, and I took the instrument off the chart because it doesn't make any difference. When order flow and momentum are aligned to the upside, you can only trade the market long. Now, I don't recommend that you trade tops and bottoms, but if you really are insistent on doing it, you can't take a reversal trade until order flow and momentum reverse, and they must reverse together. Now, again, order flow momentum aligned to the downside. But I wanted to show this chart for this reason. What happens when these two parameters don't align? They both have equal weight on determining the future movement of price. They're forward-looking because the assessment is made off your two higher time frames, not your trading chart. So when momentum's aligned to the downside and order flow is aligned to the upside, that's when price chops. And that's when you don't trade. When they align, that's when your bias is definitely short. You're never going to get caught in a counter trend trade to the long side. Now, I rely heavily on this indicator. And so far, on Monday and Tuesday, I've not taken a loser in the live trading room. Simply trading in the direction of order flow and momentum. There's another trade where there's no alignment. You have momentum up, order flow down, price chops. Then once they align, price breaks to the upside, and you have been given a direction. Now, let me tell you, what aligns order flow and momentum is one footprint of institutional money. You have to trade long when order flow and momentum are aligned in the appropriate direction, because given its own proclivity, the market will always chop. And these indicators are only going to align when the institutional traders are moving their money into this financial instrument. Now, the multi-time frame analysis of trend, I think, is an assessment that is way undervalued because it creates the most advantageous, low-risk, high-reward trades that are possible. And I have learned the hard way never to trade, or very rarely trade, without all my time frames aligned in the same direction. Now, it's hard to assess on a trading chart. Because let's say you're trading crude. That works on stocks just as easily, and I have a lot of stock examples later on. What this pink means is that your two higher time frames, remember, none of our indicators look at price on your trading chart. That provides you with no forward-looking ability. What allows you to look out into the future is what's happening on your two higher time frames, or what's happening on other markets, or what's happening using other data. And you're going to see that we have other data and other markets we look at. In this particular case, we're looking at the price movement on the two higher time frames. And well, it's 12:32 already. I'm not sure what time I have to leave, but I got to move here. So what happens is that we're only going to take it when the background bias is pink. It's because our two higher time frames are moving to the downside. Our 50 period moving average is red and heading down. The 15 period is across the 50 and heading down, and price is below both the 15 and the 50. You've got to trade in the direction of the multi-time frame analysis of trend. This indicator gives it to you without looking at three different time frames. It also does an assessment of the 50 and the 15 and support and resistance. When you get this background bias as pink, you are flying to the downside. Same thing, multi-time frame alignment to the upside. You've got a 14.25 point move to the upside and 11.75 move. This is the E-mini, but you know what? The size of the move is irrelevant. It doesn't matter whether it's 14 points, 11 points, whether it's 3 points, or whether it's 100 points. What you're looking for is a low-risk, potential high-reward entry. Now, when do all three time frames, your trading chart and your two higher time frames, align to the upside? Only when the institutional traders are pouring money into your trading instrument. It's the only time. Sometimes it won't occur in a given day. Sometimes it'll occur multiple times in a given day. We trade three instruments: crude, gold, the NASDAQ, and the E-mini. So we get multiple opportunities to trade. But you've got to wait for this. This really is a tremendously advantageous setup to provide you with an awesome long trade. And you can see all these traders caught in the counter trend direction. Again, oscillator divergence, MACD divergence, Fibonacci analysis, all the stuff that's been bankrupting traders for 2 decades. And they're still up to it, and they're never going to stop. Now, what this tells you is the 50 is heading up, the 15's heading up, the 15's crossed the 50 to the upside, and price is above both the 15 and the 50. So all resistance to the upside is broken. That's your best long trade. Now, correlative markets are really, every single thing that we look at is creating a footprint of institutional money. That's who we have to trade with, or we're going to get run over. And the correlative markets, I think, are one of the best assessments. Because what happens in the course of a day is that the institutional traders move their money from asset class to asset class. In any given day, essentially, there's only a fixed amount of money available. Yes, there's money flow in and money flow out of mutual funds over a course of time, but from the market open at 9:30 Eastern to the market close at 4 p.m. Eastern, the amount of money that the institutions have to trade is fixed. So when the E-mini, the NASDAQ, the Dow, and the Russell take a dive, like you can see the E-mini heading down here, the NASDAQ, Russell, and Dow also correlate with at least 70% of the time, correlation coefficient of 0.7. Certain trading instruments go up. They have to be moving that money somewhere that doesn't vaporize, and they're not moving it to cash. It's constantly being invested in something. Two of the correlative markets are treasury bonds, treasury notes, their precious metals, and their currencies. Essentially, what the institutional traders are saying is, I'm taking risk off. I don't want to trade stocks. I want to move my money into safer investment vehicles. And so they move it into bonds, notes, currencies, and precious metals. And what we do is we track that flow with this indicator. And each line has three markets that either correlate in the direction of your trading instrument or in the counter trend direction. So when both lines are green, they're telling you that money is flowing into bonds. Now, this is not even looking at price movement on your trading chart. The price on your trading chart is irrelevant. These are looking at other correlative markets to the instrument you're trading. Now, if this is green, it means money is flowing in. You can only trade long. Everything that I've given you so far is only a directional bias. We have not talked about entries. When it's green, you can only trade long. But it's also told you when not to trade. Now, when both of these correlative, these quant lines, looking at 6 correlative markets, are yellow, it means the institutional traders are doing nothing. All these 6 markets are just moving in random fashion, moving in random directions. And the price of bonds is just going to chop. Just like what happens when order flow and momentum don't align. Just like what happens when you don't have a multi-time frame alignment of trend. When one line is green and one line is yellow, the market chops. It needs institutional participation for you to get a trade. And remember, this is that big move we saw on the E-mini that went 14 and 11. Well, it just so happens that that money flow into the E-mini causes the multi-time frame alignment of trend. Since these are all different types of footprints of institutional money, they all correlate. That's all that we're tracking, is what are the institutional traders doing. So money is flowing in, price rises, all 3 time frames align, and that's why you have to trade long. Have to trade long. Don't trade here. Just chop. Now I'm going to skip. These are some trading examples. These are the 3 correlative markets. We get a pullback to support and a move up. That's a $280 trade on 31 ticks. This is on the NQ. And we trade the NQ. Same thing, green. Now here, one of the correlative markets was red. I still took the trade because there's a lot of things down here that I haven't really gone over with you yet. Now, I want to show you our market profile. It is the best market profile. We just updated it, and it's really an amazing tool. And I can tell you, I would not trade without it. Now, market profile is a very, very powerful assessment of the future direction of price because it's created by volume, and volume is created for the most part by institutional traders. Now, in a perfect world, the distribution of volume by price would create a perfect bell shape. And the middle of the bell would be the mean price. And in this bell, the mean is also the mode and also the median price. Wrapping around that mean is one standard deviation's worth of volume, creating a fair value price for your trading instrument. Again, you're going to see this works on stocks, futures, Forex. It does not matter what your trading instrument is. All of these things work on every financial instrument, on any time frame. I use these to trade options, and I look at 4-hour bars and daily bars. When I day trade, I look at 5 range, 8 range, and 13 range. So it doesn't matter what kind of bar you use. Now, it creates a value area high, a value area low, and a point of control. Now, remember, price wants to stay within fair market value, which is defined by the VAH and the VAL. Now, the point of control is that price that most traders love to trade this instrument today. $53.49 on February 9th was the most common price traded. It has the most volume at price, the biggest histogram bar. So when price approaches the value area high, it gets pushed down. When price approaches the value area low, it gets pushed up. And price is always attracted to the point of control because that's the price that traders like to trade this instrument most often. So this creates, based on a continuous reevaluation, intra-candle. Now, most market profiles do not work intra-candle. You have to have it work intra-candle. If you trade a 3-minute or a 5-minute candle, you can't wait till the end of the candle to know where these areas are, or you could trade right into them. Now, there's also critical low volume nodes. Those are where almost no volume at price is crossed. They're just the opposite of the POC. And we calculate what we consider to be a critical low volume node is one that's confluent to the value area low and confluent to the value area high. So price is going to be rejected from a low volume node because nobody wants to trade this instrument at this price. Nobody wants to trade this instrument at this price. Nobody wants to trade through the value area low. They want to keep price within fair value. So it creates very strong areas of support and resistance based on institutional money creating a volume profile which gives you these areas of very strong support and resistance, which are constantly changing. You don't want to trade up into resistance nor down into support. Our goal as day traders is not to get, I know most of you think that your goal is to get a winning trade, but it's not your goal. Your goal is to avoid a losing trade. That's trading with specificity. If you trade with sensitivity, you want to get every winner. If you trade with specificity, you want to avoid every loser. If you can avoid every loser, or almost all losers, you're going to make a huge amount of money. And that's how we trade. We trade to avoid losers. So anything that accrues risk, we avoid. We don't trade up into resistance or down into support. Here's what happens. It comes up to resistance, resistance holds, rejects, holds, rejects. In fact, today we saw it on gold. Gold was rejected off the value area high and collapsed. Now, it did break support. Then support becomes resistance. It comes up to resistance. Now, we're not looking at any other indicator, but if we had order flow and momentum to the downside, and we had the multi-time frame analysis of trend pointing down, and money flow is coming out of the E-mini, we have a perfect short trade, exceedingly low risk, and potentially a huge reward. Those are the trades that we want, nothing else. And here's a little bit of the analysis. You can only go short when order flow and momentum are aligned. This is just order flow. You break support here, you have a short trade to the point of control. You're sitting on the point of control, you break it, you can only go long. When you come back up to resistance to the point of control, you can only go short. And this is really going to put you in the direction that the institutional traders are moving, because this will only create this multi-time frame alignment on order flow when the institutional players are in the game. Now, you can go only right here. I put a go long, but it's really premature. You've got to wait for this to turn green, and then you have your long trade. Now, what we've done is take a massive leap with market profile. Not only do we have a point of control on the for the day, which is right here, we have the point of control of a candle. Now, this is a Sierra chart, so we work on Sierra charts or NinjaTrader. This tells you where the commitment of traders is. Some traders refer to it as the COT, some as the POC, or point of control. It's the tick value on your trading chart in your candle that accumulates the most volume. When you've got a trade entry right off of support, we've got the best background bias here, and the point of control or commitment of traders is at the bottom, and it's surrounded by intense buying. The entry one tick above the close of the candle is a very low-risk long trade. And on the E-mini, this is 13 ticks. Our first target is 10. It's about a 17 or 18 tick trade. It's not a gigantic trade, but it's a good trade. It's a safe trade. Now, with the same thing here, we don't have background bias, so we have much greater risk. And this is the point of control. So we have a lot of problems on this trade. We have to do a risk assessment. Optimally, we want the 15 below the 50. But the point of control or commitment of traders is very close to the top of the candle, and it's associated throughout the candle with intense selling pressure. In addition, this candle body is very big. And this is part of our analysis. Normally, you don't get these candle bodies. And there's the wick. So this is mostly candle body. So, and this is a double top. So off a double top, the point of control or commitment of traders gives you a gorgeous short trade. This is a 30-tick trade. $360 on our automated trade management strategy. So you can see how powerful trading, leveraging the point of control or commitment of traders is off a candle. Now here you get a move up and a pullback to support. Now I labeled this as the POC. It's not. This is the value area low. I am sorry. Here is the point of control. But so price pulls back to the value area low, and look where the commitment of traders is. As good as it gets, at the bottom of the candle. And the whole candle has got nothing but intense buying pressure. The lighter the green, the more intense the buying. And it surrounds that COT or POC. That's a very safe entry. Now, you have to worry, this is the VWAP, or value weighted average price. It's an area of resistance, but you break it. and you move all the way up to the value area, to the point of control, and that's where the trade peters out. But it's a massive trade, and the entry is extremely low risk because of the point of control, or COT, commitment to traders, inside the candle. They are committed to a long trade. Here's another trade. This is on the E-mini. And I don't have this on stocks, but you can. Oh, this works great on stocks. It's a little risky, but you have support right here. This is an unbroken pivot. It pulls back to the 50, to the pivot. The commitment of traders is all the way at the bottom. Intense buying pressure on the E-mini. Here's the candle. There's only one tick of wick. Up you go. I didn't scale the trade, but this is a very, very nice trade on the E-mini. Now let's look at the cash metrics. It's the last indicator. Our cash metrics is really also a novel indicator. Now, it's comprised of 16 metrics, not 21, I'm sorry, arranged into 4 groups, into the Dow, NASDAQ, S&P 500, and Russell 2000. And these are all the metrics that you have to put into your trader in order to get the lines to work correctly. And we format this indicator for you. It's really too difficult for you to do it on your own. But what it looks at, I'll give you some of the things it looks at is the ratio of up volume to down volume in the NASDAQ, the ratio of advancing to declining issues on the NASDAQ, if you're trading a NASDAQ stock or you're trading a NASDAQ future, the ratio of stocks upticking to stocks downticking. Again, here's the advanced decline line, but it looks at specific ETFs. It looks at the semiconductor index. It looks at 16 different things in each of those 4 baskets. It is basically bores down into market internals. And if you ever hear Kramer and all those guys going on, they all talk about market internals. Well, you're getting an analysis of market internals as you trade. Now, the upper line is all tick data, and the bottom line is all volume data. The upper line tends to move fast, and the lower line tends to move slow. I don't know why that is, but volume data tends to be much steadier, and tick data tends to, change color a lot more rapidly. And here's how you trade. You trend trade, you trade gaps, market open, and reversals. And I've got to move through this quick because I got 8 minutes left. I'm going to skip this. Now, here is green on the NQ. All the metrics are aligned to the upside. Also order flow and momentum. And on this trade, you make 40 cents on 10 cents of risk. Here on this trade on Perigo, you make 75 cents on 10 cents of risk. This is the cash metrics right up here. When you get dual greens, I am telling you, and you trade off support, remember, you can take this cash NQ and put it on the futures market. That's what we do. We look for our futures market to move in the same direction as our cash market. And those provide us with very low risk trading entries. The NASDAQ is super tough to trade. But when we wait for a dual cash signal, we have got a winner. Here's a 65-cent trade on 15 cents of risk on Tesla. Here's a 99-cent trade on a 15-cent risk on Netflix. Always in the direction of the dual cash signal. And again, going down further, there's order flow and there's momentum, and there's your background bias, pink. This is a C candle right off of resistance. Again, you get a pullback, you can only go short, and down you go for $1.05. Now here's a move up on Garmin. It's a 5-minute chart. Doesn't make any difference what the time frame is. The cash metrics are telling you that all the market internals are going up, and you got to trade. You can trade Garmin long. You have to trade it long. And you see that a lot of traders are counter-trend trading, and they're all going to get beaten up. Here's Nvidia, $1.08 on 10 cents of risk. I'm not going to talk about shares or leverage. Remember, you can use leverage, and it will magnify your wins, but it will also magnify your losses. If you're trading a $25,000 account and you have $100,000 to play with, and you trade $50,000 worth of stock, and you only have $25,000 in your account, sure, it makes you more money if you get a winner, but you lose a lot of money if you get a loser. So it's going to erode your account quicker if you trade on margin. And I recommend that you do occasionally, but in general, I don't believe you should use margin to trade, because it's really going to degrade your account if you take just a few losers. The most important thing is how much you're risking to make how much reward. That's the key parameter. Now, even if you trade 100 shares here, you're going to make $108, and you're only risking $10. That's how you day trade stocks profitably. It would take 10 losers to eclipse this one winner. Now, here's how you trade a gap. I got 4 minutes, so I'm going to have to roll. Everything that takes place on a gap pre-market is relevant. There's no way to assess a gap before the market opens. Why? The gap is created by the non-institutional traders. They're the amateurs. They're us. They're the guys that trade small lots or small numbers of contracts. We don't want to follow their lead. We want to follow the lead of institutional money. And institutional money doesn't start to trade until the market opens. There is no liquidity here to get you a trade. So if your cash metrics are green and your stock gaps up, it's going to run up. It's just that simple. If you try to give this an analysis pre-market, it tells you nothing, because this analysis is based on the non-institutional small commercial traders like us, and it doesn't give us any idea of what the institutional guys are going to do when the market opens. And you can see this gap down pre-market and then gapped up when the market opened, and then the institutional traders blew it up. Same thing with optical kinetics. It's a trade I trade a lot in with options. I got to move real quick. When the cash metrics go red, it gapped down. Here's where you take the short. Now here's an open. You get a slight gap to the upside. The cash metrics are green. Up you go. This is Console Energy. It's a 60-minute. A trader say, "Hey, can I trade a 5-minute?" This is a swing trade and a multi-day hold. You make $1.10. I didn't assess risk, but this is only a $15.90 stock. It's not a $150 stock. So you're making $1.10. That's a huge amount of money on a small stock. Same thing here with Facebook. How do you trade the open? Bam, down in the direction of the cash metrics. These are all the market internals. 9 points on the NQ. 9.25 points on the E-mini in the direction of the cash internals. The E-mini futures almost always moves in the direction of the cash markets. Market open, if they're aligned, you trade the open. 7.5 points or 1/4 points. Now these are our entries. I'm going to have to go right over them. The system generates a strategy entry. It's a multi-time frame assessment. It's a very smart entry. Here's a short. These are longs. These are we let the system give us the entries, and then we make the assessment if we like it. These are real smart entries. Here's an ABC candle. Counter trend traders in B. C overruns them. We're in one tick below the close of C. There's another C, and down. And here's our third entry, the consolidation entry. This is a multi-time frame assessment. Most systems let you wait until consolidation breaks. We predict the break of consolidation by looking at the higher time frames. These are very conservative, low risk, high reward entries. When volatility drops and the power of the bears equals the power of the bulls. Another consolidation entry. Not two other consolidation entries, 40 ticks and 10 ticks. These are the system-generated entries that we evaluate with the multi-time frame assessment of trend, order flow, momentum, cash metrics, all of that. And here's the consolidation signal with everything aligned down in red. We're blocking it, consolidation signal, everything aligned. 19 ticks, 44 ticks. 3.75 points on the E-mini. 19 ticks off this A candle down. So let me just skip through this because I got to run out of time. 43 pips, $655. This is a strategy entry. Everything's aligned to the downside. Money is flowing out of the Aussie dollar. Order flow and momentum are aligned to the downside. 52 pips, again, consolidation entry, perfect long. And I'm just going to have to roll through these. Now we have two quick testimonials. There's already 1 minute after one. I'm going to take 2 more minutes. Jersey Tony, these are both top step traders. They are two of the best top step traders there are. D. Moore won the $50,000 combine in 2016. He made $54,047. He gives us a wonderful testimonial. He went 21 straight days without a loss using our system. Now, here is our offer. We have our own trading platform where you get the entry at the touch of a button. I press the button, you press the button. You get the same entry that I do. You get much less sippage, and you get in with greater precision. You get 3 months in the trading room. And we put you in trading school. It's not 12 weeks, it's 10, but we're going to teach you how to trade a continuation trade, how to trade a gap, how to trade a market open. But we're going to do it smartly. And you're going to see how well it works and how much money you're going to make on a week-to-week basis. Last week we made $1,660. Get access to our video tutorial library, and we'll make you chart templates for different markets. And the first 5 orders also get our automated system, which takes the consolidation entry, the strategy entry, and the C candle entry on multiple markets that I can't watch. The NASDAQ, the E-mini, gold, crude, the euro currency, T-bonds, and T-notes. The total value is $9,000 and change. We're giving it to you for $2,750, your 2 payments of $1,425, 30 days apart. That's the automated and the non-automated to the first 5. Now, let me just quickly see if I can answer any questions. That's our number. I will take 60 more seconds. I don't want to run over. Hang on 1 second. Okay. All of them, Richard. This works on stocks, futures, and Forex. We can email you the results. We have them on a spreadsheet every single day. We do them. Exit is based on our automated trade management strategy, Kevin. There are 3-tick range bars, Richard. We use them to trade bonds and notes. Yellow signifies when there's no correlation, i.e. when there's no price or when there's no alignment of anything within that indicator, you get a yellow. Listen, we don't trade tops and bottoms, John. That's one thing we don't do. The stops is based on an automatic trade management strategy. It depends on the time frame you're trading and the instrument you're trading. What we do is we have a formula based on the average true range of your instrument. It's all done via the use of math. We don't do anything that's intuitive. If you're trading Google on a 5-minute, we will calculate your stop based on It's based on its volatility. That's what we will also calculate your optimal first, second, third target to scale out of a trade. That's all got to be done using math. It just can't be done intuitively. And you can't just take everything you buy and just wait till it goes to the low and take it out. You've got to scale out. That's the safe way to do it. And I'm just going to close with this. Your goal is capital preservation. Your goal is to trade conservatively, and your goal is to avoid risk. I think we give you an awesome way to make an assessment on risk. Avoid risk, take only your conservative entries, treat the capital you have in your account like it's gold times 10. You don't want to eat into it. You don't want to use it. You don't want to pull from it. If you trade conservatively and look to avoid every potential loser, you're going to make really good money. The market's going to hand you very, very low risk, high reward trades, the kind you can just drive the truck up to and take your trade to the bank. So listen, if you have any questions, our number 786-713-5276 or at www.rightlinetrading.com, info@rightlinetrading.com, and the first five will get our auto trader. And our auto trader has about a 225%, we're up about that so far year to date. Not going to make 500 million% on it, but it creates equity for you without you doing anything. So thank you, Richard. Have a great afternoon. Thank you so much for having me. I really appreciate it.
Thank you so much, Mark. Great. Thank you so much, Mark. We appreciate your presentation. Thank you so much for everyone who has been with us throughout the morning and the afternoon. Just to let you know, all the sessions have been recorded, and we're going to go ahead
you